In the name of God, the most merciful, the most beneficent. And this is my 8th lecture on chapter B about corporate finance. And we will be discussing in this portion of this my lecture derivatives, that is forward contracts. In the earlier lecture that we have talked about options, and now we will be discussing about forward contracts and futures and swaps. And by this we will end up the section 2 of chapter B. The learning outcome. So we will be discussing about the basic features of futures and forwards, and we will define the interest rate and foreign currency swaps, identify characteristics of other sources of long-term financing such as leases, convertible securities and warrants. Derivatives. So the underlying assets will be like stocks, bonds, commodities, currencies, interest rates and market indices that we have seen even in our earlier lecture. So derivative is a contract between two or more parties, we know that, agreed upon underlying financial assets. It can be either index or security. So we will be discussing in this the future contract, forward contracts, and options we already discussed, and swaps and warrants are commonly used derivatives that we will be discussing now. And the derivatives are used to either mitigate risk, that is by hedging, or assume risk with speculation for investment purpose. Let's see a forward contract example between two parties called Alice and Bob. Alice needs to return 1 Bitcoin she loaned in 3 months, but doesn't want to risk paying more than the current price of $10,000. Whereas in Bob's case, he is already inheriting 1 Bitcoin after 3 months from now, okay? But he is afraid of that if the value will go down, so he may want to cover that risk also. So in such a situation, both parties have an agreement that Alice agrees to pay $10,000 for 1 Bitcoin she badly needs to repay. So she says she agreed to with Bob that she will pay $10,000 and get that Bitcoin from Bob after 3 months from now. Bob agrees to deliver that Bitcoin, which he will be inherited after 3 months. So to Alice for taking $10,000. Okay. So now after 3 months, what will happen? The 3 months at the maturity, that Alice pays $10,000 to Bob. Bob gives the 1 Bitcoin. So this is what the forward contract. So in this forward contract, Bob is the seller and thus has a short position, while Alice the buyer and therefore has a long position. We already studied in the options case. And now let us analyze in this, what if the actual price of Bitcoin rises to $11,000 by the end of the contract. It would mean a loss of $1,000 to Bob, because the price in the market is 11,000, whereas he had already agreed as per the forward contract to sell it at $10,000. So that is the situation for him. Whereas for Alice, it will be a profit of $1,000. So okay, that is the idea. Put the same case scenario in the future contracts in order to understand the difference between the forward contracts as well as the future contracts. So future contract is largely identical to a forward contract, yes, but with the primary difference being what happens when the current price changes. As and when the current price changes, there will be an adjustment by the intermediary accounting system. Suppose Alice and Bob enter into an agreement with an expiry date 3 months from now, and the price moves up from $10,000 to $11,000 immediately the next day. What happens in forward contract? No worry, because forward contract is the term remains same. At the end of the day, the maturity after 3 months, whatever the position, it will be exit on that. So the daily changes both the parties need not be affected by that. But in a future contract, the gains and losses are settled on a daily basis. So as the buyer always receives one Bitcoin that is worth $11,000, but only has to pay the agreed price of $10,000. So $1,000 is credited to Ali's margin account the very next day even. But for Bob's case, it will be deducted. So that is, even if it is, for example, $12,000 changes, Alice will receive $2,000. Bob will, in his account, will be deducted $2,000. But at the time of maturity, the price may come down to again like $11,000 or maybe again to $10,000. But during the date of adjustment, Bob has to meet his liquidity requirement also. So that is the thing here important. This is why future contracts mean increased liquidity risk compared to forwards, where only the final value matters. In the forward contract, only the final value matters. Whereas in future contract, it's on a daily basis. If Bob cannot meet the margin requirements, his position could be forced closed and leave him with a bigger realized loss than would otherwise be the case at the end of the contract. Okay, even though at the end of the contract price will become better, but he has already faced that crisis situation. A swap contract compares best to a forward contract. It is similar to like a forward contract, but there is slight difference on that. Like for example, if it is a single swap contract, it is similar to a forward contract. But if there are multi-period swap contracts, so it will be an agreement and then again exchange, so it will be continued like that. So that is the main difference. Forward contract is a customized agreement between two parties to buy or sell a specific amount of an asset at a certain time in the future for a certain price. This is the definition. It is an instrument used for mitigating risk, but fundamentally different from options because both parties are obligated to perform according to the terms of the contract. So one party buys as a protection against possible increased price of underlying asset. That means they have a long position or long hedge, and whereas the seller will become a short hedge or a short position, because his interest is to mitigate the risk of declining price of the underlying asset. Let's see this example between a retailer and a wholesaler. They agreed in a month on the prices and quantities of merchandise that will be shipped to retailer stores in future date. Kind of a seasonal product. We can take it for an example, like Diwali festival, and if we have some products ordered and it has to come before that time. So that is the way that there is a risk also there, and maybe thinking of this kind of seasonal arrangement a few months ahead of that situation. So normally the buyer wants to lock the price as well as the suppliers source, and the wholesaler who want to sell it also want to lock the price and the customers. So this is how a forward contract can take place between a buyer and seller. Normally the buyer is betting that the price will go up, so that he want to fix the price now only for the future contract. Whereas the seller, he will be betting that maybe the price will go down, so he want to fix the customer for that now only to that fixed price. So then there is a contract. But initially when they make the contract, there is no need of money exchange, okay, until that settlement takes place. Similar examples between a farmer and a manufacturer of food items, bread maker kind of things also like that. That can happen like a forward contract example. Based on the example we just saw, we can understand the characteristics and terminology involved in the forward contracts. So we know that like one party purchases the contract, the other one is a counterparty. The seller of that contract is the counterparty. And underlying asset, it can be tangible or intangible. Party who agrees to buy assumes a long position, and who is selling, the counterparty, is short position. So the delivery price, or it can be a contract price, is the purchase price or sell price, and delivery takes place at maturity. In the forward contract, the amount of the underlying asset and the delivery date are set at the time the contract is negotiated. So if we are agreeing today for the contractual term that it will be after 3 months, which will be maturing, so we will fix the price and the date of that will be determined today, and we agree on that. But there is no need of initial payment for that, and there is no need of a premium kind of things also. So the counterparty in a forward contract is usually is the bank or a dealer in foreign exchange market. The most common application of forward is with the forex payments. Forward contracts are not traded on organized exchanges. It is usually in the secondary market. So that is the primary distinguishing characteristics of forward contracts, because they are not traded on any market or exchange, and brokers only bring together the buyer and the seller, who then negotiate the terms of the contract. Whereas the future contracts are dealt in the organized exchanges. So we have to understand the payoff structure. It's similar to options. We have a payoff structure between put option, parity of call option and put option, and all we studied. So similarly, in these forward contracts also, the initial value of your contract to both parties is zero. It is starting, because there is no need of initial payment, no premium. So the forward price determines the value of the contract. So based on the forward price, so the value of the contract price for the market is determined. If the market price of the underlying asset on the delivery date is higher than the contractual price, the party that has taken the long position benefits. The counterparty is losing here. Okay, but if the market price of the underlying asset is lower than the contractual price, then what happens? The party that has taken the short position benefits here, since he is entitled to receive higher payment for the underlying than the amount currently prevailing in the market. The significant difference between a forward contract and an option: in a contract, both parties must meet their contractual obligation, but in the option, the buyer of that option is not obligatory. Okay, but whereas in the forward contract, it is obligatory to fulfill that. So that is the main thing. So delivering the merchandise or buying it, that is primary important in forward contract. Let's see a forex related example. A US importer with a 60 days invoice due in euro currency, purchasing a forward contract for the euro deliverable in 60 days. So he is purchasing a forward contract for the purpose of covering his position that he has to deliver euro in 60 days, so that he locks in the exchange rate regardless of the fluctuation that occurs in the currency exchange rate during the 60 days period. So by buying this forward contract, so whatever the price that he agreed, so he locks that price, exchange price. So that is the idea of this forward contract. So let's check a multiple choice question. A forward contract involves a commitment today to purchase a product. So he is giving a commitment today to purchase a product on one of these options on a specific future date at a price to be determined sometime in the future. Whether the price to be determined in the future or today. So option A is wrong because the price has to be also determined now. But it is a specific future date, that is okay. So let's test the option B. At some time during the current day at its present price. So whether it is not that necessarily the present price. So we can determine a price which can be applicable in the future date, but that is the idea of the forward contract. We need not take the present price. So option B is also wrong. But what it C says on a specific future date at a price determined today. So this is exactly the correct option for a forward contract. And what says option D? Only when its price increases above its current exercise price, which is not necessarily the case. So option A, B are incorrect. C is correct. So a forward contract is an executory contract. In future it will be executed. So executory contract in which the parties involved agree to the terms of a purchase and a sale, but performance is deferred. However, the values are fixed now for the maturity date as well as the price. Okay. So accordingly, a forward contract involves a commitment today to purchase a product on a specific future date at a price determined today. Another CMA adapted question. If a corporation holds a forward contract for the delivery of US Treasury bonds in 6 months, and during those 6 months interest rates decline, at the end of the 6 months the value of the forward contract will have, see, usually US Treasury bonds are more secured, and if the market interest rates decline, so the Treasury bonds price will always be increasing. So in such case, so we know that clearly that option A is wrong and option C also wrong, because option A says it is decreasing, so it will not, and C it says remain constant, that is also wrong, but it is increased, so that is the right answer. And why D is not the right answer? Any of the answers may be correct, so that is a very vague answer. So any of the answers may be correct depending on the extent of the decline in the interest rates. So option B is correct. Interest rate future contracts involve risk-free bonds. Such US Treasury bonds is kind of risk-free bonds. When interest rates decrease over the period of a forward contract, the value of the bonds and the forward contract increase because it will pay good yield than the market rate. So therefore the value will be increasing. So in this multiple choice question, CMA adapted one. ABC company was a party to the following transactions during November and December year 1. So there are A, B, C, D, 4 kind of transactions have been described here. And the question is that which of these transactions most likely resulted in an investment in a derivative. So subject to the accounting prescribed by Statement of Financial Accounting Standards 133, because which describes the accounting standard for derivative instruments and hedging activities. So there are certain conditions prescribed by Statement of Financial Accounting Standard 133, which talks about there are 3 criteria, like it should be an underlying asset should be there, it can be a notional or actual asset, and no need of initial investment, that is also a kind of thing, and there should be a settlement, so that should be there. So with these criteria we have to read all these transactions and which one is fitting. Let's read the things one by one. So A purchased 1000 shares of common stock of a public corporation based on the assumption that the stock would increase in value. So here we are just only assuming purchase 1000 shares of common stock of a public corporation. It is purely just a purchase of a common stock directly, and assuming something will do that, now we are purchasing it. So this is not a kind of derivative. Okay, and B option is purchased a term life insurance policy on the company's chief executive officer to protect the company from the effects of an untimely demise of this officer. This is just purely taking, this is also a risk instrument, but it is just buying the policy. Here we are not determining, we are not thinking about for the future and now determining the maturity as well as the price kind of things. And there is no kind of underlying or asset kind of things. It's directly buying an insurance policy. So option C, it says a transaction about agree to co-sign the note of its 100% owned subsidiary to protect the lender from the possibility that the subsidiary might default on the loan. This is just also a commitment directly on that. Option D says based on its forecasted need to purchase 300,000 bushels of wheat in 3 months, entered into a 3-month forward contract to purchase 300,000 bushels of wheat to protect itself from changes in wheat prices during the period. So this is the kind of the right answers, because as we discussed earlier, answer A is incorrect because it involves a net investment equal to the fair value of the stock. And answer B and C are also incorrect because both are based on identifiable event, not on underlying asset. One is that B says that it is like a life insurance of the company's chief executive. So that is not an underlying asset involved in that. And second, C also like that. So D clearly says that it is the purchase of the forward contract as a hedge of a forecasted need to purchase wheat. That is the important thing as per the SFAS 133 standard, because it has got one or more underlying asset, because it has got forecasted that the goods, the 300 bushels of wheat, that is an underlying asset, a commodity. Okay, and it has got a payment provisions and require either there is no need of initial net investment on that, and requires a net settlement also after the 3 months. So that is the important point. So we are going to see about future contract now. There is similarities between forward contract and future contract, as both are like a contract in nature, both are having agreement to buy or sell a specified quantity of a specified asset and on a future date. That is okay, both have that same things. But unlike with a forward contract, the counterparty is unknown here in the future contract. In the forward contract, it's both parties are known, and in the future contract, there is no need of the counterparties, because you are dealing with a kind of agent, intermediary like banking and other things like that. The parties to a future contract have the same long and short position as the parties to forward contract. The party committing to buy the underlying asset as a protection against a possible increasing price of the actual financial instrument or physical commodity. Actually, the party who is buying will be having a long position. The party committing to sell will have the short position, whatever the party committing. Okay, but in the future contract, it is has no counterparty risk that you can take it, but it has got market risk, of course. There are two basic types of futures. One are commodity futures and another one is financial futures. So examples of commodities traded in commodity futures markets are agricultural products, metals, energy products and forest products, etc. Examples of financial futures traded are future contracts on debt securities, that is interest rate futures and stock index futures, etc. This is just a list for you to not need necessary to memorize, but just to understand and what could be the underlying assets of future commodities. like agricultural products. There are so many items, examples given, and meat and livestock, live cattle and beef carcass, other things like that, and fibers, metals, energy products, forest products. A huge list are there, but you don't need to memorize it. Just have it. So, an example, in the commodities market, a company has a futures contract to buy corn at a future date. The price on the date that the contract is entered into is used as the contract price. Because of this, if the price of corn were to decline before the contract comes due, the company would lose money since they could have bought the corn on the open market. But because they already purchased with a higher price, so they are losing. Okay, especially when the market is less than the price in the contract. So in order to prevent any loss and at the same time also to eliminate the possibility of gain from the rise in the price of corn, the company will also contract to sell corn in the future at today's price, whatever that today's price. So if the company enters into both contracts and the price of corn does in fact decline before the contract comes due, the company will lose on the corn that they buy. However, this loss will be completely and exactly offset by the gain on the corn that they sell in the second contract. So they have two contracts. One is to offset the other one, the loss or this thing. Similarly, if there is a gain also, it will be offset by the another contract, which will be because when the price is down, so that will be offsetting. Essentially, in this case, where they enter into both contracts, the company is simply moving today's price to some date in the future. That is as good as moving the same price, holding the same price for the future date also, without any upset. So, risk of leveraging on future contracts. How do we do that? When we do such kind of leveraging activities, what is that risk? So one characteristics of future contract is that it may be highly leveraged. That is okay. We know that leveraging, that means a small amount of money to make an investment of much greater value. So small change in order to gain much greater value. Similarly, the risk is also there. If you buy a gold contract worth $45,000 and pay only 10% of the price, which is like $4,500, your cost would be just only $4,500 and your leverage would therefore be $41,500. So you are just investing $4,500 but leveraging, taking that risk of $41,500 worth of that. So this enables you to take on the possibility of great gain without spending a lot of cash at the current time. So if you are good at speculating, so you have a great gain on that also. On the other hand, however, this also exposes a person to great losses. So if your assumption is wrong, forecast is wrong, so you will be gaining. If it is going negative to your prediction, so you are going to have a great losses. That would need to be covered with a cash outlay if the price of gold were to fall. So that is. In future contract, prices are marked to market every day. This requirement of daily settlement minimizes default and is the default risk also, and is necessary because future contracts are sold on margin. A mark to market provision minimizes a future contract chance of default, so that we can understand that. Why? Because it is adjusted on daily basis. So therefore, so that default risk is minimized. Another difference is that a party to a forward contract typically expects actual delivery. Future contracts are generally used as financial tool to offset the risk of changing economic conditions. The two parties simply exchange the difference between the contracted price and the market price prior to the expiration date. That's the only thing. Not necessarily actually moving the underlying assets. Let's understand the forward contract and future contract side by side with, with respect of meaning and the formation of the contract, settlement, regulation and trading aspects. So both are agreement where parties agree that there are two parties involved. Only thing is that in the future contract the counterparty is unknown because you are dealing with the standard exchange who will be acting on behalf of the other counterparty. So that is the only thing. But otherwise also that the future contract, the forward contract is kind of assets in future and at an agreed upon rate. The trading of that assets will be in the future. That is why it is forward contract and on agreed upon rate and agreed upon a date. So that is the forward contract nature. Whereas in the future contract, it will be a parties agreeing that selling a fixed assets at a fixed price in the future. But that is the thing. Okay. And formation, like it will be a unique contract in the forward contract because it is two parties agreeing and there will be a specific contract which is unique in nature and they will make it. Whereas since for the future contract you are dealing with a standard exchange, so it will be a standard contract, standardized contract. And settlement is upon maturity for the forward contract and future contract any time before that maturity. And the regulations, because it is a unique contract in the forward contract, it will be self-regulated. I mean by the parties under the agreement. Whereas in the future contract, it is regulated by the stock exchange, the standard exchange things. And trading is happening over the counter for the forward contract. There will be a broker or who will be arranging both parties to talk and agree upon that agreement and do that. But whereas in the future contract, you are going into organized stock exchange platform. With respect to other characteristics like primary market, secondary market and contract terms and delivery, these are the difference between the forward contract and future contract. Like for example, in the forward contract, as we talked about, for trading you have separate dealers arranging that, but here it is a stock exchange, a common body for that. And the common stock exchanges guaranteeing like clearing, settling and all these things happening in that. But whereas in the forward contracts the dealers are just only arranging the both buyer and seller to talk and enter into a contract and that's it. And then it will become a contract law that prevails. Contract terms negotiated for each contract, no standard conditions in the forward contract, whereas there is a specific standardized conditions are there. I mean, it's a standardized condition, not specific contract in nature. And the delivery is at the contract expiration at the maturity date, and whereas in the future contract, it is rare position or offset by delivery date. Normally, delivery may not happen, but only the positions are offset on even from the next day onward, any time. It will be offset on daily basis depending on the market rate conditions. And credit risk, depending upon the parties involved in the forward contract, there is a credit risk in the forward contract. But future contract it's none because you are acting with the standard exchange which will take care of that. Because the standard that the exchange is a counterparty to every trade and the credit worthiness of the original counterparty is replaced by that of the clearing house. Market participants, large firms only can participate in the forward contract and future contract wide variety of. And MCQ, an automobile company that uses the futures market to set the price of steel to protect a profit against price increases is an example of. So they are entering into futures market. They are using the futures market to set the price of steel to protect a profit against price increases. So they consider that there will be a profit against the price increases. So they have a future. And whether it is a long hedge or a short hedge or whether it is just selling futures or to protect the companies from loss, or selling futures to protect against price declines. So both C and D are not correct because it is given in the question that they are entering into this future market for profit against price increases, not price decline, nor from loss, company from loss. So they want to retain the profit. So it is either a short hedge or long hedge. So naturally, when you buy for the profit, it will be a long hedge to protect your gain. It will be a long hedge. So a change in prices can be minimized or avoided by hedging. Because if there is a price change, and you can have your hedge option like future contract, so that way you can set up that thing. Hedging is the process of using offsetting commitments to minimize or avoid the impact of adverse price movements. So the automobile company desires to stabilize the price of steel so that its cost to the company will not rise and cut into profits. Accordingly, the automobile company uses the futures market to create a long hedge. Long hedge means a future contract that is purchased to protect against price increases. If the future contract is sold, then it is a short hedge. Next question. A distinguishing feature of a future contract is that, so based on the definition, you can see what is that distinguishing feature of future contract. We have seen a comparison table also. There is one unique feature which is between the forward contract as well as the futures. Okay, the futures contract. So whether the performance is delayed or it is a hedge, not a speculation, or delivery is to be on a specific day, or the price is marked to market each day. So definitely the option D is the right one, because all others are like performance is delayed because it's a future. Forward contract as well as future contracts are performance is not immediate, it will be executory. So that will be future. And B is also wrong. Why? Because future contract may be speculative. It is not a speculation, it's not a correct answer. And C is incorrect because future contract is for delivery during a given month. So delivery is to be on a specific day is not the correct answer. So delivery can be even during the month anytime. Answer D is correct. A mark-to-market provision minimizes a future contract's chance of default because profits and losses on the contract must be received or paid each day through a clearinghouse. Each day it is mark-to-market provisions are set up in accounting. Swaps contract. Swaps are contracts by which the parties exchange cash flows. That's the important point here. Three types are common. One is that interest rate swaps, currency swaps, and credit default swaps. So let's study one by one. So interest rate swaps are agreements to exchange interest payments based on one interest structure for payments based on another structure. These agreements are highly customized. An example, a firm that has fixed debt service charges may enter into a swap with a counterparty that agrees to supply the first party with interest payments based on a floating rate that more closely tracks the first party's revenues. See, one party has the debt and they have to pay, but they swap that with another party in order to exchange with a floating rate interest payment to a fixed rate of interest payment. So second one is currency swap. Similarly, for currency exchange rate fluctuation, so these swaps will help. US firm with revenues in euros has to pay suppliers and workers in dollars, and they cannot pay in euros. So they want to protect that exchange rate risk, minimize exchange rate risk. It might agree to exchange euros for dollars held by a firm that needs euros. So they will find another company which need euro. So they do that through the stock exchange. So they go for that options. The exchange rate will be an average of the rates expected over the life of the agreement. And the third one is the credit default swaps. They are also agreements whereby one of the parties indemnifies the other against default by a third party. By having this swap, so one party indemnifies the other like an insurance coverage, like kind of guaranteeing kind of things. Yeah, for example, a large bank may agree to pay a constant stream of cash to another bank as long as one of the first bank's major debtors remains current on its loans. If the customer defaults, the second bank covers the first bank's loss. One of the parties is, in effect, providing loan default insurance to the other party. Unlike interest rate swaps, these agreements are usually bundled into large portfolios. So some more information on the swaps. Swap spread. What is that swap spread? It is the difference between the fixed component of any given swap contract and the yield on a sovereign debt security with a similar maturity. Similar, for example, US Treasury bill, and if it is a similar one, that you take that rate, and the difference between that, it is called spread. For example, labor rate is there, or any repo rate is there, and then the loans are having a spread on that, over on top of it, that's labor rate. What is that added value? That is called a spread. So similarly, the swap spread is the market determined additional yield that compensates counterparties who receive fixed payments in a swap for the credit risk involved in the swap. So that is the profit margin. That spread is the reward for the counterparties. The swap spread will differ with the creditworthiness of the counterparty. It depends on the creditworthiness of the counterparty, the spread also will be varying. Most swaps are priced to be at the money at inception, meaning that the value of the two sets of cash flows being exchanged is the same. Naturally, as interest rates, currency exchange rates, and credit risk change, the values of the swaps will also change. An example multiple choice question. An entity is planning on issuing at par $5 million of 10-year non-prepayable debt at 9% interest. The entity wants to convert its fixed rate interest payments, because they have to pay fixed rate 9% interest, so they want to make it as a floating rate interest payments. So based on the London Interbank offered rate. So which one of the following contracts should be the entity can consider? So whether it is options, forwards, futures, or swaps. Naturally, swaps is the ideal choice. The entity should consider a swap contract in this situation. So now we have almost completed the options, all the long-term financial instruments. The last other items are like kind of lease agreements and other securities that we are discussing. So a lease is kind of a rental agreement. Lease is a legal binding contract outlining the terms under which one party agrees to rent property owned by another party. So there are two parties, lessor and lessee, and lessor gives asset on hire or rent for use without transferring the ownership of that asset. So that is the idea. The lease guarantees the tenant, the lessee, for using the property, and he guarantees the lessor, the property owner or landlord, a regular payments called as rent or lease payment. That is for each specific period in exchange, so they will be paying this amount. So residential leases tend to be the same for all tenants, but there are several different types of commercial leases. Consequences for breaking leases range from mild to damaging, depending on the circumstances under which they are broken. So depending on what clauses, what conditions are broken, so the damage suit in court of law can happen. So some characteristics of lease. So it binds the lessee to make payments specified in the lease contract. And it can take various forms like operating lease, which can be short-term, cancelable leases, where the lessor bears the risk of ownership. Financial lease, also known as full payout or capital lease, usually non-cancelable and fully paid out. It is kind of amortization will happen over its term and where the lessee bears the risk, meaning that he will pay full sum, lump sum, and then he use it. So that is how it is like that. So when he give back that, the lessor will return back that money. So the lessee bears the responsibility for maintenance, insurance and taxes in such a case. So convertible security, like we have already studied in the shares or bonds also, it will be convertible. So such kind of things also in the long-term financial instruments. So fixed income security or a preferred stock that includes an option to exchange that security for a stated number of shares of another security. So what are the characteristics typically used to convert the security into a specified number of equity shares? So it also allows a corporation to raise funds at a cost of capital lower than a straight bond or common stock issue. So when convertibles are exchanged, debt is removed from the balance sheet. So when the company can exchange that they are no more having the debt responsibility, but it will be a equity fully after the conversion. Warrant. So long-term call options to purchase common stock directly from the corporation. That is called warrant. It gives bondholders or preferred stockholders that right to purchase shares of common stock at a given price. It derives value from the investor's expectation that the stock price will increase. See, why do investors put their money on the warrant? Because they expect the increase in price of the stock price. That's why they take that warrants. Future. One of the major use of warrants in financing is to lower the cost of debt. When warrants are attracted to the bond, it makes bonds more attractive for investors. This in turn leads to lowering of the cost of the debt for the issuer. Example. A long-term call option to buy common stock directly from a corporation is, of course, a warrant. So this will be one of the multiple choice questions. That's why I put this question. A major use of warrants in financing is to A, B, C, D. One is lower the cost of debt or avoid dilution of earnings per share, maintain managerial control, permit the buyback of bonds before maturity. So as defined, we saw earlier. So answer A is correct because warrants are long-term option that give holders the right to buy common stock in the future at a specific price. Thus, it allows to lower the cost of that particular debt, or the equity that they want to issue in order to raise the funds in the long term. Thank you. Praise be to God. And I think we have covered the section 2 of chapter B fully about the long-term financial management. So all multiple choice questions after the students do their own exercise practice. If they after completion of chapter B along with A and B, we can have questions tested through my online portal. Okay, thank you. But you need to use my email ID to call me for that when you are ready. Thank you.